Hey everyone, it's Zach back with a new mortgage video. Hope you all had a happy weekend and are having a great Monday so far. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. On today's Monday mortgage market update, I'll talk a little bit about some of the stuff that happened last week, as well as kind of the general environment we're at right now, because it's a very unique situation, and some of the things on the horizon this week that I think could impact mortgage rates. So last week was a very up and down kind of roller coaster week. We had early in the week mortgage rates improve without really any kind of economic reason for it. It was just kind of a continuation of the previous week, where we saw investors moving away from the stock market and towards safer investments like treasury bonds and mortgage-backed securities, which helps with mortgage rates. And that was driven by general fear of recession. Then as we got more data toward the end of the week, we saw kind of this up and down regression, then improvement. And we ended the week on a sour note, as Jerome Powell had some comments that kind of spooked the market, essentially him saying that the Fed is going to not cut rates until we're at a more stable place. This week, so far, we have had a continuation of kind of the early part of last week, where we've got a big drop in the stock market and mortgage rates, treasury bonds are improving as a result. And I think that is due to both Trump and Treasury Secretary Bessent signaling, Bessent on Friday, Trump over the weekend, that we may see a recession. Trump essentially said there's a period of transition as we move more from a focus on government jobs to private jobs. I talked about in my market update last week this kind of seesaw between the fear that these tariffs and tax cuts will lead to inflation on one hand, and on the other hand, the general fear of a possible recession, higher prices, loss of jobs for people that work in government, that general fear leading to less consumer spending, and therefore the opposite effect, which would be good for mortgage rates. Obviously, higher inflation would be bad for mortgage rates. So again, we're still very much leaning this way. Now, this week, as we get more significant market data, like last week, that could swing things in the opposite direction. So with that said, what you would expect in most circumstances to be the most significant reports coming out this week are Consumer Price Index, or CPI, which comes out on Wednesday. That is the first major inflation report that comes out every month, and it overlaps significantly with the Fed's preferred inflation metric that comes out at the end of the month, personal consumption expenditures, or PCE. And then we have PPI, Producer Price Index, which comes out on Thursday. That is not as much of a market mover usually as CPI, though last month it was about even, as PPI does also overlap with PCE. And last month we had kind of a unique situation where overall PPI came in higher than expected, but some of the key underlying factors that trickle into PCE came in below expectations, and so the market reaction was positive despite those overall numbers being higher than expected. We also have initial jobless claims on Thursday. That report came in a lot lower than expected last week. So if that stays the same, that's really not going to move the needle that much, but it's still going to be something worth watching until we really have a handle on these cuts in jobs, as that should trickle into that number sooner or later. So those three reports are, I would say, the traditional reports to watch. Two that I'll throw out that are not usually major market movers, but in this current environment are going to be significant, I think. Tuesday, we get an optimism index, and Friday, we get a preliminary consumer sentiment report. So both of these should give a decent gauge of how consumers are feeling right now. And consumer sentiment specifically, the final report that came out a couple weeks ago, that's what really turbocharged this drop in mortgage rates that we've been seeing. Both of those come in lower than expected. I definitely think that will have a positive effect on mortgage rates. But just the general landscape, it is very volatile right now, and I don't think things are going to move necessarily in the way that you would expect. Wednesday last week was a perfect example of ADP employment coming in almost half of the expected number, and mortgage rates got worse. That doesn't really make sense, but after we'd seen gains continuously without really any market data to explain it, it was just kind of a natural correction. So it'll be interesting. A lot of these reports that typically don't move the needle, I think the market is just kind of gravitating to anything right now. You had Friday, the U6 unemployment rate, which measures not just people actively looking for a job that are currently unemployed, but also people that are underemployed, people that have been discouraged by not finding a job and have just given up. That number ticked up to the highest that we've seen since October 2021. And I think that was part of why mortgage rates initially got better that morning. So really anything that could possibly signal the start of a recession, I feel like the market is really gravitating to right now. Or conversely, anything suggesting, like Jerome Powell did, that either inflation's going up or that the Fed is going to hold off on cutting rates for a while. Right now, the market is expecting 2 to 3 interest rate cuts this year. So if that changes, if we're looking at 0, that's going to lead to an uptick in mortgage rates. So it'll be an interesting week for just tracking mortgage rates. Also, some news today that I'll shoot a video on: Redfin being acquired by Rocket Mortgage. Very interesting, the dynamics of that. But if you have any questions on this video, shoot a comment below or feel free to call, text, or email me. But thanks for tuning into this one, and I will see you next time.